When it comes to investing, what's the biggest hurdle? It's that first few years, right? The frustratingly slow start. Well, today we're going to tackle that head on. I've got a simple but really powerful framework that's designed to completely change how you see your money grow. Okay, let's just get it out there. Compounding? Well, it kind of sucks at the beginning. I mean, you're putting your money in month after month, and you look at your balance, and it feels like you are going nowhere. And you know what? That isn't just a feeling. That's the critical moment, the exact point that separates the people who succeed from the ones who quit right before the magic is about to happen. So let me tell you about Veronica. She's a perfect example. She's 28, and for 5 solid years, she has done everything by the book. She's been consistent, diversified, disciplined, but her balance? Just $14,000. And she's sitting there thinking, is this even worth it? And that right there, that's the moment. That's the exact point where most people throw in the towel, convinced the whole system is broken. But here's the thing. The system isn't broken. They just don't understand the physics of it. And that's because, crucially, compounding isn't like simple addition. It's acceleration. The best way to think about it is like pushing a car. You know that feeling? At first, it's just pure struggle. You're straining every muscle and the car barely even budges. But then it starts rolling. And once it's moving, the momentum takes over and it actually gets easier and easier. Your portfolio, it works the exact same way. The real problem, though, is that nobody ever tells you how long you have to keep pushing that car before the momentum kicks in. And that's exactly where this framework comes into play. It's called the 7-5-3-1 rule. Think of it as a clear, data-backed plan to get you through that initial struggle and into that sweet, sweet acceleration phase. So here's what we're going to break down. We've got the 7, which is all about your time horizon. Then the 5, your diversification pillars. The 3 covers the emotional traps you will face. The 1 is your secret weapon. And then we'll wrap it all up with your action plan. All right, let's dive in. First up, the number 7. What does it stand for? It's the minimum amount of time you really need to commit to your investment strategy. We're talking 7 years. So why 7 years? What's so special about that number? Well, if you look at the data, historically, if you invested in the S&P 500 for just 1 year, any random 1-year period, you had about a 74% chance of making money. Not bad, right? But if you stretch that out to any 7-year period, your chance of seeing a positive return jumps to over 95%. See? 7 years is the magic time frame that just smooths out all the market's crazy ups and downs. And committing to that time frame does something really powerful to your mindset. It forces you to stop obsessively checking your account every single day. You stop treating your investments like a scratch-off lottery ticket, and you start treating them like a tree. You plant it, you water it, and you just trust the process. Because you don't go out and judge a giant oak tree by how tall it is in year 2, right? Okay, so that's the 7. Next up is the 5. And listen, this isn't about just going out and buying 5 random stocks. No. This is about building your entire portfolio on 5 distinct pillars. 5 pillars that are designed to protect and grow your wealth, no matter what the market decides to do. So what might that structure look like? Well, you'd have things like broad market funds for that core stability. You'd add in some dividend stocks for a steady stream of cash flow. Then you'd sprinkle in some small and mid-cap stocks for that higher growth potential. Of course, you need international exposure, so you're not just betting on one country's economy. And finally, some defensive assets like bonds to act as a safety net. The whole point here is that these pillars often move independently. So when one is having a bad year, another one is probably doing great. And that's what protects you from getting totally wiped out. All right, so you've got the right timeline, you've got the right assets, but there is one final major obstacle. And that obstacle? It's your own brain. This brings us to the number 3. This represents the 3 totally predictable emotional traps that are absolutely going to try to derail your progress. And believe me, these traps are pretty much universal. First up is doubt. This hits you in years 1 and 2, when your balance looks, let's be honest, kinda pathetic, and you start wondering, am I doing this all wrong? Then comes frustration. That usually shows up around years 3 and 4 when you've poured in thousands of dollars, but you're just not seeing that amazing growth everyone talks about. And finally, the big one, panic. This can strike at any time, usually when the market takes the nosedive and every instinct in your body is screaming, sell, everything. So how do you survive this? The key is to build a system beforehand to defeat these emotions. It's actually pretty simple. First, just check your account less often. Seriously, think quarterly, not daily. Second, automate your contributions. Set it and forget it, make it effortless. Third, and this is a big one, change how you measure success. Don't focus on the dollar value, focus on the number of shares you're accumulating. And lastly, do your homework. Study market history. You'll see that every single crash in history has been followed by a recovery. Once you truly internalize that, panic starts to look a whole lot like opportunity. Okay, so we've covered time, diversification, and emotion. Now it's time for the accelerator, the real secret sauce. And that's the number one. What is it? This is your secret weapon, making just one small annual increase to how much you invest. And the impact of this one little change is absolutely staggering. Let me run some numbers by you. Let's say you invest $300 a month for 30 years. You'll end up with around $408,000. Not bad. But what if you increase that contribution by just 5% each year? We're only talking an extra $15 a month in year 2. Your final balance? It jumps to over $787,000. That is a difference of nearly $400,000, all from a tiny adjustment you would barely even feel. Here's another way to think about it. It's like lifting weights at the gym. If you just lift the same 100 pounds every single week, you're gonna hit a plateau, right? But if you add just a little more weight consistently, you just keep getting stronger. Well, your money works the exact same way. A static, unchanging contribution gives you linear growth. But increasing your contributions, that's what unlocks exponential growth. So, there you have it. That's the 7531 rule in a nutshell. Now, let's bring this all home and put it together into a clear action plan you can actually use. All right, let's look at Tom's journey. He starts this at age 35, and he follows the rule to a T. So after 7 years, he hits age 42, and he's got about $50,000. He's officially past that tough frustration phase. By the time he's 50, that's grown to $165,000. You can see the momentum is starting to build. But you have to watch what happens next. By age 60, he's at $480,000. And by 65, he blows past $750,000. Get this, he made more money in the last 10 years of investing than he did in all the previous years combined. That, my friends, is the acceleration phase we've been talking about. Now, let's compare Tom to his friend Jake. Jake started with the exact same amount of money, but he completely ignored the rule. He panicked and sold when the market dipped. He paused his contributions to buy a new car. He basically just reacted emotionally to everything. And the result? By age 65, he has less than half of what Tom has. What does this prove? It proves that having a structure and being disciplined is so much more important than trying to time the market or just getting lucky. So here it is, your 5-step plan to make this happen. Number 1, commit to 7 years. I mean it, write it down somewhere. Number 2, structure your portfolio using those 5 pillars we talked about. Number 3, automate everything. Your contributions should just happen without you thinking about it. Number 4, plan right now how you're going to handle doubt, frustration, and panic when they show up, and they will. And finally, number 5, go into your phone right now and set an annual calendar reminder to increase your contribution by at least 5%. When you really think about it, that slow start of compounding, it's not a bug in the system. It's actually a feature. It's like a filter, and it's designed to weed out the impatient people so it can massively reward the disciplined ones. So the only real question left is, which one of those are you going to be?